Welcome to the 3 Edge Week in Review for the week of April 24th. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge. Joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3 Edge Asset Management. This week, Steve and I will discuss why it could make sense for investors to consider holding some amount of gold in their investment portfolios. First, a brief recap of the activities in the markets, and the S&P declined earlier in the week and then bounced back later in the week. There was a report showing that U.S. economic growth slowed to 1.1% in the first quarter, and that was down from 2.6% in the fourth quarter of last year, which may indicate that the Fed's effort to slow the economy to tackle inflation is working. However, we remain in a somewhat range-bound market as investors wait for each subsequent FOMC meeting to see the path of monetary policy. The CBOE Volatility Index, known as the VIX, a measure of equity market volatility, has actually fallen to its lowest reading since 2021. And meanwhile, the big news in the capital markets will take place next week at the Fed's next FOMC meeting, when we'll get the announcement of the Fed's decision on monetary policy. The consensus estimate is calling for a 25 basis point increase in short-term interest rates. But barring some unforeseen policy surprise, investors will be more focused on the Fed's written statement and what Chair Powell says during his press conference. Will the consensus among investors be that the Fed's sounding more hawkish or sounding more dovish? So, along with everybody else, we shall wait and see what happens next week. So now let's get to today's topic and talk about why it may make sense to include gold as part of a diversified investment portfolio. And by the way, this year, 2023 year to date, the price of gold has risen by around 9%, outperforming the S&P 500 year to date. So Steve, last week I attended a conference, and one theme that came through was that oftentimes advisors like to use 3 Edge because they benefit in relying on us to make investments in less traditional asset classes beyond stocks and bonds. And an excellent example of an asset class somewhat non-traditional is gold. So my first question is, why might it make sense for investors to consider holding some amount of gold as a long-term strategic investment?
Well, Fritz, first of all, there are circumstances where what we call a black swan event or a very unpredictable event just comes out of the blue. And all the assets get hit in your portfolio except gold. So there are times when gold is the only asset that's going up and help offsetting losses in other assets. And so just as an insurance policy, we think it's really important to have gold as part of a strategic or permanent part of one's diversified portfolio. But beyond that, a second reason why we think it's so important to have gold as part of a permanent or strategic holding is that the purpose of building a diversified portfolio is to participate in each of the 4 major phases of a market cycle. So I want to point to what we call our seasons of the market chart. And as I've said before, we've used this before and we'll use it again in the future. But it shows the 4 basic phases of a market cycle. And any diversified portfolio should have a component or an allocation within it that participates in each of the 4 major phases. And we know when you're in winter, which is the recession, along with disinflation and deflation, that's when long-term government bonds do well. When you're in the recovery mode, that's when equities do well. Well, that's just 2 of the 4 major phases of a market cycle. When the economy overheats, and it's a result of monetary inflation or the Federal Reserve Board printing too much money, that's when gold outperforms. And then when you go into the fall and you have your credit contraction, when the Fed realizes they've done too much stimulus and now they've got to pull back, sounds familiar, that's when you get your credit contraction. That's when Treasury bills outperform. So think of it as 4 major food groups, so to speak, but 4 major phases of the market cycle. And gold is a very important component of that 4 phase of the cycle. Now, the third reason why it's important to hold gold is that with the growing threat of recession coming and the escalating government debt burden that we're facing, and not just our country, but many countries, gold is an excellent hedge against the future prospects of the Fed having to go back and print more money. because gold is priced in dollars. When the Fed prints money, in essence, it's devaluing paper money, and gold will hold its value.
Excellent. So, slight nuance then to my first question concerns when does it make sense then to tactically increase or overweight the amount of gold in one's portfolio above and beyond that strategic purpose?
So when building a diversified portfolio, we talk about a strategic component and a tactical component. And the strategic component is so important because it really represents the idea that no one can perfectly predict the future. Things can happen out of the blue, and you need some protection or some participation in all the phases of a market cycle ahead of time, because you can't always predict when something's going to come out of the blue and hit your portfolio. So that's the strategic or permanent part. But then beyond that, we use our model, we use our investment committee's experience, we use all of these things to help determine when certain asset classes are poised to outperform. And gold being one of those asset classes, we have a gold model, and it encompasses many different inputs. But one of the key inputs I'm going to show on a second chart. And it really shows an incredibly great inverse relationship between the price of gold in the gold color and the change in real or inflation-adjusted interest rates in the blue color. And there's a whole logic behind this. If you can be compensated really well by owning a bond way over and above the rate of inflation, or when that rate grows, then hold the bond. You don't need the gold. On the other hand, when you're compensated poorly, when the interest rate is falling relative to expected inflation, or even negative, then gold is much better bet. And you can see this inverse relationship has worked over time. And more recently, we've seen that the blue line has stopped climbing and now is starting to fall. And that's partly because interest rates seem to have peaked at the 10-year level, partly because expected inflation seems to have bottomed, and now people are worried it's going to be stickier than they thought. And so if this blue line comes down, this could be a further impetus for gold to go up. And right now, we are advocating an allocation of gold above our minimums, our strategic minimums. And we'll continue to be watching these variables as it affects the outlook for gold to see if we might need to add even more.
Okay, so my next question is that we know that, frankly, some investors just don't think it ever makes sense to hold gold as part of a portfolio, maybe except in, very extreme situations. And we do know that gold, doesn't pay any income. There's no dividend. It just sort of sits there in a vault and, doesn't really do much. But so perhaps it could be enlightening to show how has gold as an asset class performed over an extended period of time.
So first of all, I want to say that it is counterintuitive to think of gold as a part of investment portfolio where, like you said, it just sits on a shelf. But we think of gold as an alternate form of money or store of wealth, because gold is always priced in U.S. dollars. And U.S. dollars you can think of as fluctuating in value when the Federal Reserve Board prints huge quantities of money or takes them out of the system. It's literally changing the value of U.S. dollars, among other things. So you're right that some people think, well, I just need to own gold for this month because there's a lot of geopolitical tension, or there's some other reason why they're nervous as a hedge, but they don't think of it to hold more than a very short term. So just by way of comparison, let's look at the 25 years. So since 1998, we've had 3 bull markets in equities. The S&P 500 with dividends reinvested gained 491%, or that comes out to 7.4% annually. Now we're going to show a chart showing that tremendous gain over the last 25 years in the S&P 500. Well, gold actually outperformed over those 25 years, gained 552% or 7.8% annually. So it doesn't necessarily have to just serve as a short-term hedge. It can be a long-term investment in your portfolio. It can have all those advantages I discussed as a strategic holding. It's a form of insurance, as the one asset class that does well during the summer analogy where we talk about overheated economy. But also, it can perform well over a more extended period of time, especially when the Fed is printing a lot of money and you have a lot of monetary stimulus.
Great. And that gets to one of my favorite topics concerning how we invest, and that's the idea of positive drift, where different asset classes perform differently over certain periods of time, but they all tend to rise over time as well. That chart, though, is really astounding. My final question is, as always, based on what we've discussed here today about incorporating some gold into a portfolio, so where we are right now, how should investors think about perhaps including gold in their portfolio?
So we think that right now, gold is perhaps an even better hedge against a possible equity downturn than, say, bonds, where bonds are still yielding below the rate of inflation. So not a great deal for someone buying bonds. Whereas gold can be an excellent hedge, especially if the Fed either pauses raising rates after the Wednesday meeting. They might raise rates another 0.25% and then pause. Or if a recession comes later in the year and they have to actually cut rates to accommodate a recession, we like gold as an excellent hedge. So we continue to be cautious on equities. We continue to be cautious on long-term bonds. We continue to prefer short-term treasuries, but we're moving the time horizon out beyond the risky period of the debt ceiling impasse. And then we continue to hold gold as a hedge against either the Fed having to weaken monetary policy again or financial repression in the future.
Excellent. Great. Steve, thank you very much for insights into the reasons why it could make sense for investors to consider a position in gold in a diversified portfolio. So that will do it for Steve and me for this week. Next week, we'll be turning the calendar into May, and that means Eric Beagleisen and I will be presenting our monthly View from the Edge, which will cover our most recent outlook for the global capital markets based on our proprietary research model, and will highlight how our outlook may have changed over the course of the month of April. As a reminder, all our videos are always available on our 3Edge YouTube channel. If you enjoy these videos and haven't yet subscribed to our channel, we would be appreciative if you would consider subscribing. In addition, all our written commentaries are always available on our website, and that's 3edgeam.com. So, until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.